Are you thinking about leasing a new car and trying to get a better understanding of how car leases work and trying to get a better understanding of the advantages of leasing a car? Well, in this video, I'm gonna give you 6 things that you should know before you lease your next car that will definitely help you with your leasing journey and save you money. As some of you know, I'm a big proponent of leasing vehicles over purchasing new vehicles because when you get a great lease deal, financing a car just doesn't compare. And I know that some of you watching think that leasing a car is a scam, but it's really not. And by watching this video, you'll get a better understanding of why, for the majority of us, leasing makes more sense than buying a new car. And if you want to see a video I did last week about why leasing a car is better than financing a car, I will link it below. I highly suggest that you watch that video in addition to this video to get a much better understanding of leasing. But with that, let's jump into the video and discuss the 6 things that you should know before leasing your next car. The first thing that you should know is that leasing a car means that you are simply paying for the depreciation of that car, or in other words, you are simply paying for what you use. Let me explain. Now let's assume that you bought a car with a $40,000 MSRP, and let's assume that this car has a residual value of 60%. Another way of thinking about a 60% residual value is that the car will depreciate by 40% over the course of the lease. And in this example, the lease term is 36 months and 36,000 miles, which is a 3-year lease that allows for 12,000 miles a year. And this is the most common leasing term that the majority of leases come with. That means that at the end of the lease term, which is 3 years and 36,000 miles, your car will be worth 60% of its MSRP. So that means that this $40,000 car is expected to be worth $24,000 after it's been driven for 3 years and 36,000 miles, or in other words, it will depreciate $16,000. Now, if we take this $16,000 and divide it by 36 months, it will give you a rough estimate of what your monthly payment will be. And in this case, it would be approximately $444.44. Now, you may be wondering, where does this residual value come from? Well, that's a great question. The residual value is set by the auto manufacturer. So as an example, if you bought a Toyota Highlander, Toyota has to estimate what that Highlander will be worth after it's been driven for 3 years and 36,000 miles. A lot of people think that the car dealership sets the residual value, and that simply isn't true. The auto manufacturer sets the residual value. Now, there are some other charges in leases like finance charges and taxes, but in essence, leasing is paying for the depreciation that occurs over time from you using the vehicle. And at the end of the lease, you can buy the car for its residual value. And in the example that I provided, that means that you could buy this particular car for $24,000 at the end of the lease. Now, the second thing that you should know about leasing is that some cars lease better than others. Now, let's use our previous example and assume that you have 2 cars that each cost $40,000. Let's just assume that one car is a Toyota Highlander and the other car is a Honda Pilot. Now, just because these 2 cars cost $40,000 does not mean that your monthly lease payment will be the same. In fact, the monthly payment on these 2 cars could be drastically different. And the reason that the payment could be drastically different really boils down to 3 key factors. The first factor is the residual value that is set by the auto manufacturer to estimate the car's value at the end of the lease. The second major factor is the money factor. And the money factor is essentially the auto industry's fancy way of expressing the interest rate. And the third factor is cash incentives and discounts. Now, discounts are how much of a discount you were able to negotiate on the MSRP, and incentives are mainly rebates that you may qualify for. So in essence, just because 2 cars have the same MSRP does not mean that they will have the same monthly payment in a lease. As an example, the Honda Pilot could have a residual value of 48%, and the Toyota Highlander could have a residual value of 65%. Now, the car with the 65% residual value will have a much lower monthly payment, assuming that all other things are equal. Similarly, if one car has a higher money factor than the other car, the car with the higher money factor will have the higher monthly payment because that's essentially a higher interest rate. assuming that all other things are equal. And a quick tip regarding money factor, it's really easy to convert the money factor to an actual interest rate. Now, typically the money factor will be written in your lease contract as a number like 0.00101. It's really confusing, but all you have to do is multiply that number by 2,400, and that will give you your annual interest rate, which in this case would be 2.42%. And also, remember that residual values are not negotiable. They are set by the manufacturer on a monthly basis, but money factors are negotiable. So make sure that you are multiplying that awkward number by 2,400 to make sure that you're not paying an obscene interest rate. And lastly, the third factor that would impact your monthly payment is the discount you negotiate on the car and any rebates that you qualify for. Now, if both cars have a $40,000 MSRP, but you negotiated one car down to a selling price of $37,000, obviously that car is going to have the lower monthly payment, assuming all other things are equal. And a helpful tip here is that for each $1,000 that you negotiate off of the selling price, your monthly payment will typically drop by about $30 a month. And really quick, if you guys are getting value from this video, please remember to hit that like button so that this video is recommended to others. And please consider subscribing to my YouTube channel. We are officially over 1,100 subscribers. And that brings me to the third thing that you need to know about leases, and that is that leases are negotiable. Now let's take a look at this advertisement that the local Acura dealership here in Seattle posted for a brand new MDX. It says that you can lease a 2022 MDX super handling all-wheel drive tech for $549 a month for 36 months. And if we take a look at the fine print, it says that this $549 a month is with $78.99 due at signing. Now, from the looks of it, this lease looks non-negotiable, but the fact is that it definitely is negotiable. You can see here that this lease is based on a MSRP of $55,945. So that essentially tells me that this dealer is basing this lease with no discounts included, and they are also asking for almost $8,000 down, which I would never do, but more on lease down payments later in this video. But to summarize this section, you will see lease advertisements that look like they are non-negotiable, whether it's on a dealer's website or on the manufacturer's website. But the fact is that they are negotiable and you should negotiate them. And that brings me to the fourth thing that you should know about leases, and that is that you should never put a down payment on a lease. And there are two reasons that you should never put a down payment on a lease. The first reason is that if your car is ever totaled or stolen, you can walk away from a lease without penalty. And the reason that you can walk away without penalty is because of gap insurance, which is included in every lease. However, it is not guaranteed that you will get your down payment back if your car is totaled or stolen. So for that reason, do not put a down payment on a lease. Now, let me clarify something. You most likely will have to put money down on a lease. Things like the acquisition fee, the first month's payment, taxes, registration fees are necessary to put down. But in terms of additional cash, do not put anything down. And the second reason that you shouldn't put a down payment on a lease is because it really obscures the cost of the lease and makes it more difficult to compare lease deals. I mean, if you think about it, you can make any car in the world have a $300 a month payment with enough money down. So to make the leasing process easier and to protect your money, do not put cash down on a lease. And the fifth thing that you should know about leasing is that someone else takes on the risk of depreciation. You see, when an automaker sets the residual value of a particular model, they often overestimate or underestimate the car's residual value, aka what it will be worth at the end of the lease. For instance, in our example earlier in this video, the car had a $40,000 MSRP and a residual of 60%, which means the manufacturer is estimating that this car will be worth $24,000 at the end of the lease term. But what if that car is actually worth $29,000 at the end of the lease? Or on the contrary, what if that car is worth $19,000 at the end of the lease? Well, if that car is worth $29,000, you probably won't want to turn the car in. Instead, you'd want to sell it right before the lease ends to a dealership or to an online marketplace like Vroom or Carvana and actually make some money. Or you can buy the car for $24,000 at the end of the lease because that's your right, and you could potentially drive it for a couple more years. And since you have equity built in the car, you could probably drive it for a period of time, essentially for free. But if the car is worth $19,000 at the end of the lease, or less than the residual value of $24,000, it probably doesn't make sense to buy the car or sell it to an online marketplace. In this case, it probably makes sense to just turn the car back to the dealership and walk away at the end of the lease. And that's the beauty of leasing. It's really hard for manufacturers to estimate what a particular car will be worth 3 years down the road, and that typically works to your advantage. And the sixth and final thing that you should know about leasing is that when you lease a car, you are only paying sales tax on the depreciation, not the purchase price. If we look at my previous example where the car had an MSRP of $40,000, if we were to finance or buy this car, we would be paying $4,000 in taxes, which you can never get back, assuming a 10% sales tax rate. But in most states, including Washington State, where I live, you only pay sales tax on the cost of the lease, aka the depreciation. So using my previous example, you would only be paying sales tax on $16,000, which is the depreciation, instead of paying sales tax on the purchase price of $40,000. And assuming a 10% tax rate, tax on $16,000 is $1,600, and tax on $40,000 is $4,000. So you'd save $2,400 by leasing this particular car. And this is another thing that I love about leasing, and this actually is so overlooked by many people who think that leasing is a waste of money and time. Well, ladies and gentlemen, thank you all for watching this video, and I hope that you found this video helpful and informative. I truly believe that once you get a good lease deal on a brand new car, you will never finance or purchase a new car ever again. And I think the reason that many people don't lease their cars is because leasing is more complicated and generally has a higher learning curve than simply financing your car. And I really want to change that sentiment because the majority of us could save hundreds or thousands of dollars a year if we truly understood how car leasing worked. And by watching this video, I hope that you now have a better understanding of car leasing than you did before. And as always, let me know if you have any questions by dropping them in the comment section below. And please remember to like this video, and please remember to subscribe to my YouTube channel. And with that, I'm out. I will see you all next time.